whole point is the price of risk. Okay, the price of tail risk is higher today than it was before. Has the equivalent of that index, which we used to compute as traders from before, from price of volatility and stuff, is a very poor predictor of events. So if I take the 1987 crash, in August it was the lowest. The August before the October 1987 crash was the lowest. Likewise, 2 years later. Likewise, when we had the huge volatility of the Gulf, first Gulf War, right before it, and it was very high. Okay, before the effective launch of the Gulf War. So it's a very poor index. I would say it's a horrible index. It's actually, if anything, negatively correlated to what happens later. Because what happens is that when people are cautious, this to me describes a caution level, how much people are paying for insurance. And when the caution level is high, people are prepared for events. It's when people are not prepared that things go bad. I have no particular specific reading on markets. I mean, I'm a skin in the game person. If I like something, I own it, and I don't own India, so I can't talk about it. I cannot be a commentator, but I can tell you what I own. I like gold. I like to stay away from currencies, particularly at current interest rate levels. I like to stay away from bonds, okay, and I like to stay away from stocks if possible. No, and other inverse investments like betting on. I don't expect that the bond market will crash, but if interest rates go higher, you see, you get paid off handsomely. If they go lower, you don't have a lot of room to go. So it's much better to be on the short side of the bond market. I would say something like negative 120% stocks now. Right, depends. Okay, and at the same time, convex hedged, of course, and negative 20% bonds, and so you really cannot add up because it's with some leverage, and have some investments in hard things like real estate, some stocks, long convex stocks. And also, I'm not yet there, but I would like to short oil. Okay, I'm not. I mean, I'm slightly short oil. I'm increasing my oil shorts because I believe that it doesn't take much to make oil demand for oil. All you need is for it to drop 5 to 10% for the market to experience what was seen in the 80s. Okay, I have to say that you have to avoid that most people, what I say, like Fat Tony in my book, his name is Fat Tony, say it's not the same thing, T-I-N-G, it's not the same thing. Markets and events are not the same thing. And like in reference to the the first Iraq War, the war started, and of course stock market rallied and everything, and gold collapsed and oil collapsed. So, although people would have expected the opposite, so people don't know how to translate Brexit into a market. It doesn't map easily for people. But I think that this is very good for the UK long term because it's freed them from doing business with Europeans who are like handcuffed, and partake more of a Commonwealth type. Commercial activity, and go back to the Anglo-American sphere that was dominant until someone in the 60s decided to start integrating with Europe. So I think it's probably long-term good for the UK, and I own pounds. Right, it's a skin in the game. I own British pounds. Okay. So I don't know if it's a great bet, but it doesn't. Sorry, it's like psychological. When I own it, I don't feel, any anxiety. But when I don't own it, I'm afraid of missing on something. And then the other thing is you have to make room for a huge growth in crypto that's going to be taking place to replace conventional central banking. I don't know how it translates in the price of Bitcoin, but I know definitely that there's going to be an increase in activity in crypto. I just visited, I go to Lebanon frequently, and I saw what the central bank did there, the damage it did. And you tell yourself that basically anything that transfers currencies back to individuals in a more organic way is more efficient. Okay. So you can start your own currency if you have the will, and the collective currency is something vastly more robust than an individual single currency, by fiat or issued by a bank. Okay, so the first thing you learn when you start getting involved in the market is, again, not the same thing, concept. The Fat Tony expression and anti-fragile that I keep telling people, you have to, markets and economies are not the same thing. Markets are largely driven by a few companies, as you say, for the tail of companies, and interest rates. Okay, so if you start raising interest rates, markets are going to collapse, and probably you'll be raising interest rates because of a healthy economy. So what we've had in the US is largely interest rate driven big rally over the past 9 years, with some, of course, healthy corporate profits, but without the interest rates, we wouldn't be here. But now I realize that interest rates don't have a lot of room to go on the downside everywhere on the planet. So, you got to realize that maybe that story is over. But one has to be careful. I can talk about it. I haven't invested, but I don't understand it. It's very, very hard for me to invest far away from things I understand. But overall, I'd like to. I come to India. I've been in India maybe 9 times. It's my 9th visit or 10th visit. And one day I'd like to invest in learning the language also, so I can communicate. The problem is everybody speaks English, which makes it hard. I'm extremely, to tell you, long term. So to talk about India, I can talk something more structural. I think that just like your IT sector here is extremely dynamic and really it's like doesn't depend on India, it depends on worldwide demand. Hopefully you'll have more sectors linked to it. It will trickle down or trickle to other sectors. See, where they start seeing some real risk taking.